joining us this morning, this week's Coffee Morning, hosted by Pension Playpen and the wonderful Henry Tapper, who will be talking to Ian Mcknight. And I'll hand over to Henry in a minute. First of all, we are recording, so thumbs up, John, Ian, Henry, everybody. Everybody's happy to be recorded. And we'll put the video on the library this afternoon. Cheers, Podrick. That's really cool. As usual, we'll open up the chat room. If you want to ask any questions, put your questions in the chat, or even better, raise a hand, because as you know, I and Henry like to be interactive on these sessions. So without any further ado, Henry, I'll pass to you to introduce the session. And thanks all for joining.
Okay, well, thanks, Steve. I'm sorry for any background noise, but I'm in the service offices of a company that we have just acquired, and it appears that there's quite a hoolie going on down the corridor. So I make no promises that I'll be able to ask all the questions of Ian that I wanted to. So you may have to just carry on regardless if a lot of noise in the background.
I've just been moaning to Henry that we're not sat actually in front of a roaring fire, frankly.
No,
it's mis-selling.
Yeah, fireside chats have got better than this. I've known Ian for some time, and I have to say it's been quite a pleasure. And I expect that most of the people on this call either know him directly, or if they don't know by his reputation, because he has been one of Britain's leading CIOs for many years. And in fact, if you look at the invite to this event, you will see Ian when he was a baby. He looks like about 11 years old on the photo Steve has managed to dig out. I haven't known him quite that long, but I'm pleased to see that he continues to keep his childish good looks and puts us all, the rest of us all, to shame. My first question is to you is, how do you manage to do it, Ian? I mean, you are a senior in this industry, and yet you look as fresh as just arrived.
Flatterer. So there's a picture in my attic where I look about 500 years old. Yeah, that's Dorian Gray, right? So no, I got the CI at Royal Mail when I was rather young, so I feel like I've been doing it forever, but I'm only 46.
You're only 46. So how young were you when you got the CIO role?
Gosh, 30, something like that. 30. About that.
That's a pretty meteoric rise to stardom, if I might say so. How did it happen? Talk us through it.
How did it happen? Well, I've been consulting for about 10 years. I joined Morgan Stanley, unfortunately, in the financial crisis. It's terrible timing. So I started chatting to Royal Mail. I think that Heath, who hired me, was looking for a head of investment strategy. And, you know, it dragged on and on. I did some consulting in the meantime. And then they came back and said, oh, we can do this now. And so I went there. But shortly after, of course, it was announced that as it was like 20 billion or something at that point, right? And it was announced that the government was looking to privatise the business. It was balance sheet insolvent. They needed to get that company, running properly again and sort out the pension deficit. They had, of course, as you know, a contribution holiday under various governments that had lasted for many years. So, as part of that, we were looking at basically not being there anymore, in essence, or having a very small residual asset pot. And so Jerry, the old CEO, was up for retirement.
This is Jerry the Goat.
That's right, yeah. Heath, who'd been head of fund and investment, left to do other things. And so me and Chris Hogg, who lastly went to National Grid, of course, ended up sort of Johnny on the spot. Me on the investment side and him on the CEO. And so, we just got sat in the chair running one of the biggest pen deals in history, which is quite remarkable. But we nailed it. So, it was a great experience. Really quite remarkable. But that's how it went.
I mean, I hadn't actually meant to sort of like play on this youth thing, but now you come to mention it, all of this happened very quickly, didn't it? Could you just sort of, but for those people who don't know Talk us through what actually happens in those heady days, and how you managed it so that it became what seemed to be a fairly seamless, from the outside anyway, transaction. I'm sure it wasn't from the inside.
Well, thank you. I mean, I'm glad it looks that way. We always get accused of making things look too easy, but of course, the reality is with any project that it's bloody hard work, you know, and that's frankly what it was. It was the most stressful time of my career, and I'm sure Chris would say the same if we get him on. It was bloody hard work, and what we did was say, look, we rushed into meetings to the government and to the sponsors and with the unions and with the boards, and you've all sorts of stakeholders to juggle and get through it. And it wasn't clear it was going to happen. There's resistance. There's making a case. There's a lawyer, and it was a cast of thousands, frankly. And it's like conducting an orchestra. So we smartly, with hindsight, got it. Said, look, we need proper project managers. At least, it was like, where are we going? You're rushing from one to the other. You need to log it, make sure you follow up on everything, plan it all properly. So we got in a few project managers to help manage us and manage the process. And so we spent an awful lot of time working weekends and nights, and it was exhausting. I broke my leg, I think, just before it actually happened as well. I'd been playing football.
We keep on talking about it. There will be people on the call who won't know quite what it is, Ian. So have to just take a step back and explain what it
was. I see.
Sorry.
So yes, okay. So basically, all of the past service liabilities of Royal Mail's pension plan were to be moved to the government, basically moving off balance sheet. What's now the statutory pension scheme for them as its own trustee, but the assets disappeared to government. So the mission was to close the scheme at a fixed date and end accrual at that date. But, and this was after protracted negotiation, I'm sure you're aware, to keep it open for X years. And I suppose I can say it now, but that X was spurious, right? I couldn't really fathom how the maths made this X feasible, personally, but X was the number, and it was 6 years of accrual. And if you consider that at a later point, the cost of that accrual was up to 80% of somebody's salary at a point later, but it was a very expensive commitment for 8 years. It's a Rumpelstiltskin pass. We literally, you've got to weave gold from straw to make this affordable, right? It happened that way, but it wasn't a certainty that would be the case. So the date was set, and basically you have to pass those liabilities to the government and to and the assets that backed them, but also they left us a reserve for some of the future accrual, like a bit of a risk buffer, or covering X years of accrual or something like that, which was determined to be at £2.2 billion. And just the public number, I think, was 30.5 billion. But when all said and done, I think it was 32.5 in the end that we passed to them, because there were two things. One, at a very late night, selling down the futures overlay on the equity side, which meant that the day after, when one of the transition managers dumped the assets into the market, and you can see it on April that year, 2012, market sold off. So we'd sold it the day before, but you had a lot still of the physical shares that hit them, and they were expecting it. So, that is what it is. But that added a bit, and also there were some assets that we spoke to the government representatives in BIS about to hold and run off. And one of those in particular, the high yield book, retained for another year or two, doubled pretty much from where it was, if you remember, post-crisis. So there's tremendous value in there, and we have to get it out. And I think, the chair got made a dame for that and other things. Because I think the story is quite charming. They refloated, they unmothballed the HMS Prince of Wales, the sister ship to the Queen Elizabeth, and so everyone's very happy. about that.
So it was
so you're writing checks for like £5 billion. Then you work for Royal Mail. I was like, well, pop that in the post to get it over to Miss. I remember stopping at that one, thinking, I think we'd better courier this. It's quite remarkable.
the check for £5 million is in £1 billion is in the post.
$1 billion, yeah. Well, yeah,
£5
of
billion
course, yeah.
in the post.
I'm sure it would have got there next day. It would have.
Well, I hope so. Special delivery.
Yeah.
Wonderful. Con, you have a question at this point. Get off mute, Con. Con, press that button. Get off mute.
Sorry, daughter's laptop again, hence the Elspeth nonsense on the screen. Very simple question, Ian. Why on earth were you transferring cash, i.e. money, rather than transferring the assets in specie?
Oh, I see. It wasn't money. I was being flippant. But it was a £5 billion transfer. And
Okay.
the paperwork.
So it was actually done.
It was just a ridiculous thing to do personally. Oh, of course, yeah. Oh no, it was planned to death. And remember, there was a huge multiple network of transition managers appointed by the government to lay this stuff off. So some of it they were happy for us to sell and give them cash. But a lot of it, frankly, was gilts, right? Which got marked off. I think it was a quarter of the national deficit that year, or it was 30 billion. I think it was 120 that year. So it's quite a material trade for them, and kept the aesthetic economics looking good.
It completely changed the face of the budget that year, if I remember rightly. There was this sudden windfall.
But it's on the back of a terrible time, wasn't it? The bailouts of the banks and all that.
Yeah,
quite bonkers. And you were asking Henry what it was like. There was a lot going on, and when I'd broken my leg instantly, you end up doing more, don't you, if you sat at home? I think it was one evening, and we did. We've been looking at one of the transitions in the previous year, a bit more BAU stuff, and we found there was a fraud where somebody double charged us, and then that took a multi-year episode of working with. The police statements here got passed to America, so we were speaking to the DOJ, the SEC, the FBI came to see us, and we ended up flying over with Dean at Sainsbury, and had the guy from Ireland phoning me up absolutely fuming. I think the Q80s had been done as well, and it created this snowball of people very angry with a provider who'd been fraudulently charging, and we had to go and be witnessing their prosecution in Boston, which was probably the most intimidating thing I've ever had to do. When you sort of say you're drinking coffee and you go, oh. And I remember my hand was shaking because it was quite.
Why was it so?
I don't tend to get very nervous, but that was quite something.
Were you under duress? I mean, was there? Did you?
No, not at all. No, I mean you've got a very aggressive defence like that, and it's just the whole scene. You're in got the big crest of steel of the United States, big armed guards on the door. It was quite a scene. So that was pretty intimidating. But they went to prison for it. I think they were among the only white collar criminals to actually get punished for the financial crisis. So it was quite the coup for the district attorney who was on it.
Yeah,
that was quite an experience
about this at the time. But I mean, this was all going on, and you were just a callow youth,
right? Yes.
We think of CIOs now with grey hair, look a bit like me, coming to the end of their career, and this was all happening, with you in your, at a stage where most of us would
prime.
Absolutely, you were in your prime. So since then, I mean, you had this enormous task. Has it all been a bit of an anticlimax, or have you found things to do which have amused you and kept you busy, and it probably kept you in rations?
Do you mean the pension, since the pension transfer, or since I left Royal Mail?
No, I mean once you'd finished the transfer. What were you able to do?
Well, looking back, then the fun began, right? So what I'll now later look back and call an open architecture fiduciary in-house job, right? So we ran it in-house, piecing together advice from, a range of providers. So it wasn't led by an advisor. We kind of ran it, and with a very supportive board and tight governance, and some amazing people who've passed through the ISC, the investment subcommittee there. And we had a really, really elegant solution to the complex problem that is trust model is not a great way to run billions of pounds and the most complex, structured instrument there is, right? So
tell us about this elegant solution. Yeah.
Well, yeah, it's basically, we did a big research paper with Russell on it. It got them to sponsor this, and I think Kevin Wade helped us. Another big funder that was working at Talent, I think it was at the time, to explore what it would take, what's great governance, what does it look like, and it's the right information, assessed by people with the correct skills, but the power and autonomy to make that change in an appropriate time frame, right? So those three tenets, however you want to describe them for a glossy, but that's it's fundamentally it. Being able to do stuff on our wall, we sat down with the team to get people like their values. What are our values? And it was sort of a bit like rule number 1 was have a can-do attitude. Rules 2 to 10, see rule 1. It was how can we do this? And because we had this sort of backs against the wall feeling in our team, it was quite entrepreneurial and startup feel. There weren't many of us. We didn't get massive headcount, far from, quite the opposite. And so we ended up having to, pedal 10 times as fast, or, people were asked to do an awful lot and be very flexible doing it, but not to drop a plate, because somebody else will take the credit, but you will absolutely get the bullet if it goes wrong. So we're very mindful to not blow the thing. And frankly, it's hundreds of thousands of pensioners. I read somewhere it's like 1 in 200 people in the country that are work for Royal Mail. What an amazing stat. Something like, you can fact check me here, I don't know. But it was about that. And that's an awful lot of responsibility, because this is their families, them and their families' retirement, well-earned retirement, So we took it very seriously, and thankfully, as time, it went really well. It was a litany of just one thing went well after another in the investment portfolio we put into, some remarkable things. So we went from no alternatives, effectively some legacy fund private equity, to direct hedge fund program, absolute return. That's because to get over the fact hedge funds are risky, we just had mad off, right? So you put in a very high bar, independent ODD for everything. We do our own and buy in what we wanted for investment due diligence. But the operational due diligence was tight. And so we basically had our own hedge fund portfolio, private debt portfolio, direct private equity portfolio, latterly VC, private real estate. We had a direct book and fund of real estate book. And then we had 2 sections, of course. At that point, we had the post office legacy, which was bought out in 2016, and then the Royal Mail section closed in 2018. There was a new section there, the lump sum BB cash funds launched then, and that ran on until just now, in fact. So, and then they're all fully, I left it. I can't tell you now. I left a few years ago, but it's all fully funded, and it's a good luck to them. It's job done. But there was a lot to do, and it all seemed to go quite well. But we had a very supportive board to enable that, I must say. They were wonderful with us.
It's more than fully funded. It's massively overfunded now, and it's almost embarrassingly rich. And would you put this down to your good offices, or is this a matter of good fortune? Or
you might very well think that, Henry. I couldn't possibly comment. It's not for me to judge it. It was great. Right, it went very well. And there was a very great many people involved in it.
The last time I looked, it was 2.5 billion in surplus, which, bearing in mind, for total surplus of this country, in this country, that's about 1% for total surplus of DB schemes. Yeah,
it's a delight. Job done.
Well done. Okay, and the nation can feel very proud of you. We
If
can also
only they
feel quite
knew.
proud- We can feel very proud of you. Right? I'm blowing smoke up your nether regions.
Well, where's this going is what I'm worried about.
Where's this going? Where am I going to?
Going?
Where am I going to?
Getting me nervous.
Go
on.
No, I'm not, because not only that, but the Royal Mail, off the back of that, has been able to do good things. And without Royal Mail, without doubt, we would not have the potential for a CDC regime. We obviously have one CDC scheme, it's yours, or it is your former employers, I should say. But no one can be in any doubt that Royal Mail spent an awful lot more setting that CDC scheme up than anyone else could have afforded to do. And I suspect that this has a lot to do with, again, with the fact that it was properly funded in the first place.
Well, you know, the unsung hero of that was Kevin Westbrook, who came in to see Chris and me one day, chatting about what could it look like once the other section shut, right? And then we sent him over to see John, and as you know, the rest is history. But that's how it started.
You
Because we were rambling on
on.
all sorts. We'd actually set up a DC scheme that got pulled on the week before it was going to launch because it had been agreed with the unions in the background. I'm sure you know much more about that side of it.
I can tell you,
but it was Kevin.
funny.
It was Kevin who suggested the format, and that's thank you, Kevin Westbrook.
Thank you, Kevin. You're down in Bristol, feet up.
Legend.
Genuine fire. There's a very funny story about the DC scheme, if I can tell it. I was at Zurich. And Zurich were the people who had the job. We were down to the last two or something like that. And the trustees of the Royal Mail turned up in a pair of Jaguars or something like that. And my colleague John Pearl and I had gone to great lengths to lay out the red carpet for them. What we hadn't done is told the porters at the gate that the Royal Mail were coming. So anyway, these Jags turned up. Bloke leaned out in broad West Country accent. This is Cheltenham. Where are you from, then? And the driver said, "We're from the Royal Mail." He said, "Oh, post rooms around the back."
Brilliant. Absolutely.
we had to retrieve.
I can imagine the scene
to the post room. There's much amusement. Sorry. Anyway, that was by the by.
Wonderful.
Yeah, this is.
I love the Royal Mail. I love the Royal Mail. In fact, I did spend my last Christmas with them down at the sorting office in East Grinstead, who were wonderful. And we, it was a real camaraderie getting the Christmas post done, and everyone's trying their best. And they actually let me do a delivery round. So I went round one of my pals and took their whole block's mail. So they got their Christmas post. Yeah, it was great.
Did. You got a particularly heavy Christmas post. I should imagine you were weighed down with Santa's bag of swag.
Well, we tried our best. There's a lot of letters. It's insane.
Were you wearing shorts?
I didn't actually. I didn't. It was a bit cold. But they all do. Yeah. Everybody loves that post.
I think we've gone as far as we can do with this.
Right. Yes. It's yesterday's news.
You left Royal Mail rather than become outsourced as a sort of outsourced CIO.
Why?
And you presumably didn't want to do that. Can you explain, why not?
I think my original hope was that we'd be able to take our model and do that elsewhere. But with Royal Mail, it's kind of done, right? So that was obsolete, really. So what I do now is quite a I mean, how do you follow a job like that? This is always my issue. How do you, when you've had something such a remarkable time from being 30 to 45, what do you do now? What do you do, right? And so, because it was constantly interesting, so I do lots of things, right? And so I spend I spend 2 days a week working for the wonderful team down at Cartwright, the employee benefits consultancy on the investment side, helping people become aware of what we're doing there as well, but adding to the intellectual property of how we can get some of the exciting ideas into smaller and medium-sized schemes.
Cartwright announced this week they have a client who has bunged some money into Bitcoin. Were you behind that?
Oh, yes. I am absolutely not behind that. I can't take any credit whatsoever, but there's a wonderful team there, as I say, of like-minded people who think creatively. And yeah, that was announced yesterday. We've had the first UK client into Bitcoin. You'll remember Wisconsin, the best funded plan in the US, state plan, did it there. And we've led that here. I think it'll lead the way to many more. People tend not to like going first on new asset classes. Remember, people didn't used to like going into hedge funds, and now lots of people do. They didn't like private markets. Now everybody is. And I think it's that as well. I mean, Bitcoin is a fascinating asset. It's very risky, but its expected return is very high if you understand it. There's some great stuff. I'll plug the website here. Have a look on what is money. I'll explain why. It takes a lot of, you don't simply walk into Bitcoin. You have to understand what it is, why it would be in there. It's a very small allocation. It's great for portfolio efficiency, and it has the upside potential, which could make a difference at that level. So getting the custody of it's really tricky, and you need to do it correctly. It's not like buying it on your app for yourself. It's institutional, so it's got to be very, very secure. And people need to understand what it is, what the risks are, and how it fits in, and have the time frame to do it, crucially. So it's heavily caveated, but yes, they've done that, and I'm very proud of the team behind that. But there's all sorts of exciting things brewing. All roads lead to two things at the minute. The discussion in the market is decumulation. People are getting to the peak.
Decumulation.
And inflation, of course.
And inflation. Now, so talk
and
to us
Bitcoin
about
helps
inflation.
with that too. Well, inflation, just everywhere you look, the answer's inflation, right? We've had monster debt. We're going to get monster more debt. We've had upsets at the bottom end on the food supply with the Russia thing. We had the oil shock, and people's standard of living is ridiculous. It's obvious. So you're going to get inflation to inflate away the debt. They print. There's lots of features. There was one yesterday, I think, doing the rounds on the US money supply. It's the same here, the M2. It's grown every year, so people are getting poorer. It's a redistribution of wealth. So all we're arguing about with taxes and whatnot and pay rises is who's paying, where's the money, which demographic is it coming from, and where's it going to? Right? That's kind of the government's job, and they can argue about it amongst themselves. But from an investment point of view, you can see the answer is clearly that we're going to have inflation. So how do you protect real value? And this goes to Rachel Ree's comment suggestion the other day, and all the Mansion House chats that we were on about last year, and we will be probably this. How do you get real pensions and long-term money to help the economy? And this ties in very nicely with all the decumulation problem that the world's facing. Obviously, I was chatting to somebody on LinkedIn the other day from the local government schemes where there's never a situation where they want to hedge. They're like, we've got a great covenant. It's a moral hazard, right? Covenant, and what happened, of course, if they hadn't done, we wouldn't have had to put so much into them from the taxes along the way, right? But once you've gone down that route and not hedged and gone to here, then you might as well wait it out. I can follow that rational logic, but there's never a good time, is there, for them? You can never get them to say, well, when would you hedge? The government doesn't hedge. Well, you're not the government, you're the taxpayer. So it's kind of this interesting thing. So you've got them, bless them, going at the long-term real assets, local infrastructure, energy transition projects, all this chat of there, but good, some good investments, some poor. Did you see the publicly listed offshore wind farm? It's kind of being propped up by subsidies. So you're doing a tax subsidy arbitrage, and you're making money out of it. That feels sort of morally wrong, but okay if it's there. So there's lots of issues with it, but how can you do that in a good way? And they're one block of pool of assets that do it. You, of course, know of another one that's looming, but there's a myriad of people coming up that can provide that. And I'm involved in several of these, right? So not least, I'm on your board at the Super Haven, which will provide that. We can talk about that as well. I'm involved in the Tontines project, which I can explain if you like. And also, there are disruptive issues bubbling up. I think we've got somebody on the call who might represent one. Cedar and M&G are working a brilliant solution to the traditional buy-in model, which is effectively lend us all your money at, the traditional model is lend us all your money at gilts, we'll put it in credit and we'll keep the credit spread. So they're making, that you mentioned the surplus before, add 10% of the nominal as well, it's probably more, right? So there's people could get that can go into the real economy, and in the multiplier, that could be a material punch into GDP, given with 600 billion of this stuff still to buy. It's great for the real economy, right? So there'll be a whole range, 3 of which we just described, of options available to people when they retire or when their scheme retires, when they're decumulating, to still be able to have those assets benefit the real economy, invest for longer, and make them more money and better off, but also keep it out of the hands of insurers, frankly, and keep it where it was earned and belonged over many decades. It's the last of the family jewels, the last of the family silver, so I'm quite protective about it. And in fact, I'd say I'm on a crusade about this now. It's just giving that away is in my opinion, reckless. But we've got a governance problem as usual, right? So trustees' fiduciary duty is, you tell me, it's to pay the benefits that have been accrued. So there's not really a material interest in giving them more or giving the sponsor more or keeping it running on all of this. And so all else equal, they're rushing like off the cliff. It's like any insurance contract, you buy it and you're locked in there. But they're rushing to do this. And I would suggest that there are things coming down the line, both on the retail independent individual market and also in the bulk space, that mean pause for thought might be required, because you'll probably get much better value with what's coming than what you might get today. That said, for schemes of a certain size, the cost of doing so doesn't make it really worthwhile for them. And they're quite right. So it's one of those, in the right circumstances, you should absolutely, especially a lot of the clients at Cartwright, actually, we are small, medium schemes. It doesn't make sense for them to try and be smart and eke out a bit of extra value, because actually the burn rate of the status quo is too high. And so there is a trade-off. But for schemes over a few hundred million, I would guess that sort of number, you absolutely should have a look around before being bumped into by the sort of matrix of the industry who want you to do a deal with them. Have a good look about what's really going on and understand the economics, which are eye-opening, to say the least. You're on mute, Henry, sorry. I rambled on at you there.
No, it was rather good. You did ramble on. I've now swapped this rather skanky corridor for a very noisy room in this building. So I hope I'm not, that's why I was on mute. But that was brilliant, and it gives all of us a whole load of things to think about. I mean, I'd love to ask you more questions about tontines. I'd love to ask you about pension suit behaviour. I'd love to ask you about all the things you were talking about with M&G and so on. But I think I've asked you enough questions. There's other people on this call who may well want to jump ahead. I've seen Mr. Adrian Swells has just arrived in person.
Hi, Adrian. Hello.
Yeah,
I thought you were in Spain. Are you in Spain? No, you look in Barbican. He's on mute.
You are on mute. Well, it's nice to see you.
Hello.
Places.
Hello, sir.
How are you? You're sounding good form anyway.
Thank you. You look well.
Scrub up occasionally.
Oh, well. What's occurring?
Any questions?
Oh, sorry. I thought Adrian was asking you a question.
No.
I think we should introduce Con again, because there's a question here or a statement about crypto. Con, are you a fan or not a fan of crypto?
And you are on mute, Con.
Yeah, no, I've taken myself off mute. I've managed to find that control. I'm actually a little bit concerned about buying crypto. Ian Clacker and I wrote a paper a few years ago now on crypto. The particular concern I have with Bitcoin is that the maintenance of the ledger on which Bitcoin exists which is paid for, which is actually work done by these miners with hash numbers and so on. But they get paid for that work by the issuance of new coins. And the issuance of new coins is quite simply inflationary. So you are actually, the process of maintaining the ledger will tend over time to debase that currency or that coin. And that
So you're
to
talking
my,
about the growth of the supply of it.
The supply here is actually coming about because what you're doing is you're printing new coins for nothing other than work done on the ledger itself. That means you have a constant supply of new coins, and that will inflate.
It's not constant, it's fixed. So in about 15 years, I forget the exact number, there will only be 21 million.
It's fixed.
But
it's fixed until you get there, because when you get there, if there isn't ongoing maintenance of the ledger, it's valueless.
Yes, but it is absolutely fixed, and it will devalue. Yes, you're right, but sorry, not devalue. You can split it many ways, and if you consider that it would be replacing, in essence, fiat currency, that's being printed at whatever it is, 8% a year. So it has the same problem, except there is no such cap there, nor is there really proof of work behind it. Most money is just a fallacy on a bank's balance sheet. They're issuing debt, so it's unbacked debt. It's not even gold backed anymore. And so Bitcoin has all of the character. There's 6 amazing articles I'd point you to on Cartwright's website about what is money, and it is the hardest form of money right now that you can get. And it's the big thing was institutional adoption. About 10 years ago, maybe just after 10, sorry, about 8 years ago, I remember looking at this and somebody was talking about all these different coins, and like you, I was very skeptical about it for the reason you described. But it has gone through a threshold, in my opinion, that makes it still very volatile, and still it behaves in the way it does because of its halving. But it's that whole in the limit tends to zero thing, and so you never reach zero, but it's aiming towards 2020 half and half and half and half, and it goes in the limit and comes, and that will push its value up, you see, over time. But you need people to want to use it actively and have demand for it, and we certainly have that growing exponentially today. But please do read the detailed articles on it, and with several specialists, I am not among them, who can put your mind at rest on it. But I have absolutely think it's a brilliant idea. But you wouldn't bet the farm on it, as with anything, right? You wouldn't bet the farm on things that can go to zero, but people buy shares and they can go to zero too. So look at it a bit like that. You probably got more Nvidia in your portfolio than Bitcoin, for example.
I'm actually short of Nvidia.
Well, you know why it's gone mental, right? Because of the chips they make to support the AI networks, which are going to just go mental as well. So there's sort of support for why it's done it. But yeah, anyways, for example, that one.
Okay.
That makes a market.
Thanks, Con. Right. Now, normally we have loads of questions, but this is quite an area of obscure interest that we've been discussing Bitcoin aside. I'm quite interested to know why, and I don't fully understand this, why the tontine thing is so interesting to you as a CIO, naturally. So talk to us a bit about that, Ian.
It's so the tontine.
Yeah.
Sorry, yeah. To tell you, I'll just give you a description of what it is. About 150 years ago, they were everywhere, right? People issued debt on tontine, intergenerational exchange, but I'll come to that. So with a tontine, with an annuity, sorry, everybody understands that you put $100,000 or pounds into an annuity, you get, say, £4,000 until you die. If you die tomorrow, the insurer keeps it. So you make a decision when you retire: how much do I leave in drawdown for my family, whatever, and how much do I want a lifetime income? And 15% of people buy an annuity. But fascinatingly, 50% or more, might be 70, but 50% of people want a lifetime income. And this is a key point. And when tontines were prevalent in America in the late 1800s, half of US households had one. This was their vehicle of choice. And unfortunately, the insurers of the time who ran them had lots of clauses in. So, for example, if you don't make a payment, your whole accrual disappears. And there were lots of dodgy goings on. They were investing it in private equity deals and things that blew up, and very, very risky assets. And of course, the insurers all went bump, and they reinvented themselves with new annuities. The annuities we know today, the vastly more profitable income for life model, which is what they did. Now, what I like about the modern tontine that we've got, and it's tontine.com. Please go have a look. You can put yourself on the list. So that the next year, I suggest we'll be talking about this a great deal more when it's launched. So the idea is that there's 100 of you in a pool. You each have $100,000 for the sake of argument, or pounds, and you get your £4,000 a year. But then somebody dies, and then Henry, you're an Oxbridge man, I think, aren't you? You'll recall from your interview. It's 1/9, so you get 1,111, and you each get 4,444 recurring pounds a year, and so on until the last person dies, and then they win the pot. It's the Hunger Games, last man standing. It's a Hunger Games of pensions, and the beauty of this is, in answer to a gentleman's question of what is the difference between this and CEC, you are going into a tontine with people, your gender at birth, so your statistical likelihood of death is equivalent, is why we do that, and your age, plus or minus, just within, like your age within a year. And so you have a very clear pool of people who are just like you, and we want you to live as long as possible. So it's a very healthy, go and live for ages. But the algo, so it's people die, you can't cheat death, and the mortality credits you get when people die outperforms pretty much everything. It's the best asset I've seen. I just love this asset, right? If you're all you have to do is live long enough, right? You just live, you just outlive your average, everybody else in your pool. And if you die, you don't care, right? Just like buying an annuity, if you're dead, you don't need the money. But you can be content knowing that the people just like you from in your pool will be benefiting after you're singing with the harps at the pearly gate. So I think it's a wonderful evolution. The reason I love it so much is it's a pure play on mortality that you don't get anywhere else. It's in insurance, it all gets muddied away. It gets siphoned into the profits of the insurer. On top of that, as we've heard, ample credit spread they're taking out, notwithstanding the MA book, they get a lot of money out of those pools. And the TDC, although it gives you some way toward this, is more of a with profit. It has an intergenerational exchange aspect to it. So you have younger, depending on the lucky generation, as we've seen with my parents' generation did rather well. I think it's my brothers, actually, the baby boomers did rather well. Mine kind of got the other end of the stick, and hopefully, God willing, the children will have an even a nicer ride through the tax systems than we've had. So I love it. I absolutely love it. It's fair, it's transparent, it's an income for life, and it's what people want. They want an income for life. And there are a myriad other things coming that will give you shades of grey toward that. That might be more appealing or not, but a tontine is the purest way of accessing that mortality. And that is just the cash version. So imagine, and there's no guarantee with it, unlike an annuity, right? So what do you do if cash rates? Well, you might drop, but of course your mortality credits are already kicking in, and so on. But what you could do is simply flip to an active fund. And this is where I think, from my point of view, it's very interesting. If you could replicate the portfolio I ran for 13, 14 years, and it still does that, a high returning, very low risk endowment style book, that's a very attractive combination. And it also enables you in that Tontine to be a long-term holder, a long-term investor into real assets, the real economy. It's great for banks, permanent capital. It's great for infrastructure projects that need financing at an appropriate rate. It's just great. I can't see a loss, and this is a win-win-win. And I love that it's for the consumer. Among the best things that can
it's
happen.
a lovely concept. Now, how do you organise it? Because that seems to be critical. How do you get groups of people together to work, in each other's interests?
Yes, and so
and
if
not
you look
fall
at
out with each other?
if you look at tontine.com, it is a fintech in essence. It's an algorithm that supports it, and all you need to do is go on, choose your edge, click, and become a member of one, and you are pulled together with people your age, and you can do that. And so have a look, and it'll describe all on the website.
Okay, has tontine.com actually got anybody who's actually done click yet?
Oh, sorry, it's to launch next year. That's why I'm talking about it
Okay,
now.
so it's not
Wait till next year,
happening.
you'll know all about it. But that's coming.
Okay.
That's coming very soon. Yeah.
Well, I'm sure
very
it'll get
excited.
all the questions which we get, which is how does this the regulatory landscape and so on.
Exactly. Yes, and we'll answer them. Yes, as you will.
And as Pension Super Haven and all other innovations will find, because they aren't actually written down as part of the regulatory landscape, they have to find their own way.
Precisely that.
Okay, well,
but the key is on all of these solutions is to act in the members' best interests. And I think they're just passively in the US, where a lot of the insurers can't offer annuities through IRAs, for example, because they're not acting in your interest. There's hidden costs. That they're reinsuring off to Bermuda and buying private equity and other things with it, right? Which is the Bermuda Triangle problem. So they can't really offer that into the market in the way that a trustee arrangement can, that's acting in your best interest with proper fiduciary responsibility. And I think, like Superhaven, gives you that comfort. So must anything that's trying to do similar on a mortality basis.
Yeah, I mean, obviously, Superhaven is different in as much as it's got,
of course,
capital behind it. It guarantees things. Well, it doesn't guarantee things. It gives people a greater degree of certainty. Is it a compromise? Is it just a sort of a tontine with a bit of a blemish, or do you think it's got value? Is that right?
Say that again. So is what a tontine with a blemish?
I'm sorry, I'm talking about Pension Superhaven now. Is Pension Superhaven just a sort of like a second-rate tontine, or do you think there are values in the certainty for having a capital-backed structure gives it?
Well, you get once a bit like CDC, you are effectively getting a capital guarantee. At Tontine, you get the mortality credit, the pure play on that. With these solutions and the Superhaven among them, you get the capital in that you wouldn't otherwise, and it's effectively backing you into a DB pension scheme economically, but like a worth profit. So it's a bit like CDC in that regard, but you can get that go up or get bonus on top and get sharing basically the upside of the risk that the capital provider is taking. Understandably, they take some for putting that in. But you get a share of that on top of what you have purchased, which is your lifetime income, which gives you that security that, as we know, 50 to 70% of people want at a certain level. Obviously, with not trivial, but what's the word? Smaller pots. When people get there, they're not going to perhaps put £5,000 into to buy an annuity, even to buy anything to get £5 a year, whatever it is, £50 a year. So they're not going to do that necessarily. Some people might, but I think for material pots, and lots of people that have DC pots that are coming up now and increasingly into the future will absolutely have those pots. And maybe some people a few years ago took their money out of a deal. Well, I know, from the publicity that you issued, there was a very public example of somewhere where they were told to encouraged to leave a DB scheme and now have a pot, and they're like, this isn't what I thought I was getting, and so they want that back, and then this will enable people who want that to get it, and I think it's a great evolution as a concept.
So what we're seeing is,
I wish you every luck with it, of course. Sorry,
I'm getting from you a couple of really interesting ideas based on the same theme. You've got CDC, you've got tontines, you've got the pension superhaven model, which is a DB decumulator, and you're constantly talking to me about inflation and how we protect ourselves against inflation. And I mean, I remember going back to my early days, back in when I was 20, and I came into this industry, and somebody said to me, the only way you can invest, you can protect yourself against inflation over the long term is by investing in real assets. And it strikes me from what you're saying that nothing really has changed in 42 years since I started out on this thing. I mean,
I think that's fair, and you need there's lots of ways of cutting it. Like if you invest in the stock market, look at the multiples in the US. You're kind of going, okay, well, is that just the new base? Is that now the price of risk? And you're like, well, I'd look at it with a filter on and say, well, which fundamentally, where is the inflation going to bubble up? Which companies can pass that through, which have elasticity of pricing, and can pass on that and continue to grow their margin and therefore your profits and maybe your multiple, right? Or however so you want to look at it. But there's got to be a smarter way of sort of axing it than, we heard earlier about, NVIDIA. You end up just being overweight these. And similarly in credit, how can we look at that and say which ones are more likely to suffer and go into distress? There's not been a big period of distress lately. The distress managers are screaming, saying there's nothing for us to do. It's not that exciting, right? We're due some, frankly. We're due some. It's election year. It's absolutely ripe right now. So earlier this year, through Cora, we were talking about trying to get people into some put spread collars or reshape their equity risk, because I'm worried, right, about the downside. What's the risk to return? We talked about Bitcoin. It's got high risk, but it's got high return. We would expect. Can you say that today about equities? Well, perhaps you can for some shares where they can pass through inflation, but for others, maybe not, right? And so it's a really fine tightrope, I think, people are walking, investing. But real assets, what do they give you? I've been doing some stuff as another one of my projects, helping a wonderful chap at Hineni placing income strips. Right, and we did a lot of those at Romeo, where you have take it out of LDI, and you're getting quite a spread above your gilts and over 30s. That's a material pickup in things like this. But you get RPI linkage, RPI plus linkage on some of these securities. But you need to know what you're doing. The sweet spots that in the market that are a bit smaller than other deals, and how do you put them together and structure it in such a way that you can access it. And moreover, at the risk of rambling again, I'm thinking out loud, you see, as I do. The DC world is ripe for a bit of this as well. Why haven't we seen Bitcoin into DC yet? Why has nobody done it? Because they don't want to go first. Why haven't we got the default going into illiquid? We were looking at doing that, but events superseded at Royal Mail. You can ask Ben about our plans there. But there's some really cool things that you could have done and make liquidity an option. The regs to have daily liquidity and to have a fee cap. As I told the chap who's now LCP at the time, when he was the minister, you're asking us to do this job with one hand tied behind my back. That's right. Yeah. And he said, well, it's only going to go one way. At the time, he might have changed. I think he's changed his tune on this side. But at the time, he was going, we need to protect members' interests, and we did this for all those million corner shop workers, he said. And I was like, what about the 10 million occupational DC workers? Because you've just made that job of making them a good pension much harder, right? And so why aren't there these innovations in that space? And people are looking toward it now. You see the liquid, semi-liquid, liquid long-term asset funds, but you don't need daily liquidity in that. The supers in Australia get around it, but of course they have underwriting, they have people gaming it, they have all sorts of second order unintended consequences of doing it, but it's feasible. You just need somebody to underwrite liquidity for you, in essence, and not have you forced sell off like we saw in October 2020, which is that ruined my I was planning a winter break, and I had to spend 2 weeks on the phone shuffling the deck to make sure the collateral's not going to burn through and all of this. It was fine, but you know what I'm saying. And all these second order problems that are caused by not thinking things through, we saw perhaps in the budget. So I'm on a bit of a rant here, aren't I?
Well, you're not. It's not really a bit of a rant at all. It's an extended rant, and I think it's rather good.
Thank you.
Yeah, I mean, we managed to get 58 minutes into this call without mentioning the budget, and now you've blown it right at the end. We've got Mansion House speech coming up in a couple of weeks. I fully expect Rachel Reeve to do part 2 of the budget, which is this is the upside, and this is how it's going to work for pensions. What we've had in the budget was probably the biggest blow to pension adequacy we'll have for a bit, which is like 2.5% payroll tax. And what I hear from all my friends in IFA land is pensions are no longer the safe haven for inheritance tax they were. We're going to actually have to start spending them a bit.
They don't want you to have cash. They don't want you to take the cash, clearly. They want you to put it into lifetime income, I would guess.
Well, you can see the direction of travel, can't you?
Well, I think that the LGPS will pool into one, as they've indicated, and it is it's a tacit sovereign wealth fund, and that's why they're being encouraged to where they are. I doubt very much whether those trustees are happy with being leaned on. It's not a sector I cover expansively myself, but I dare say that will be the sovereign wealth fund in waiting, as was probably always the plan when it was pooled into £30 billion bucket, as I recall. Not coincidentally, I might suggest, but that's me speculating.
That's you with your conspiracy hat on there, Mr. McKnight.
Just looking at the facts.
Looking at the facts, drawing inevitable conclusions. Well, we have had a quite splendid romp through pension innovation. And I think the only reason we haven't had a plethora of questions has been because we've wanted to hear more from McKnight and less from each other. But thank you to those like Con who have asked questions. And thank you most of all to Ian Mcknight for giving us the most entertaining view of the world, which comes from the bright spirit that all those years ago set up and delivered that massive risk transfer from the Royal Mail's balance sheet to the government's. So ask everyone to say thank you very much, and I'll hand back to Steve.
Thank you, Henry.
Thank you, Ian. Thank you, Henry. Great session, everybody. Really appreciate your listening to Ian, who's got some great ideas and great innovation. Obviously, we're off to buy Bitcoin this afternoon for all our pension providers, especially Con. Con's going to go and buy some Bitcoins, aren't you, Con? But listen, great, Ian, fantastic session. Thanks for your time. Thanks,
Steve.
For
So give me a call. I can probably sell you some Bitcoin.
Oh, okay. Yeah. Well, Ian might buy some, so there you go. I'll give you a call.
Any shy askers, please get me on LinkedIn. You'd be more than welcome to
contact Ian on LinkedIn, or
contact
if you want
me
to contact
directly.
Ian direct, please do. Henry has got his details, so that's great. Really appreciate everybody's input today. The recording will be up later, plus the podcast. Next week, we have got Tom McPhail, who will be giving us probably some post-budget analysis and also pre-Mansion House speech ideas. So join us next week for Tom McPhail. As we always say, peace. Let's pray for peace in the East and peace in the Middle East. And we might as well say peace in Valencia as well, because that's a shocking event. But yeah, crazy time. But thanks everybody for joining, and really appreciate everybody's input. We'll see you next week on the next coffee morning. But Ian, thank you again. Really appreciate
Have a great week, everybody. Lovely to see you all. God bless.
Take care.
Bye bye.
Take care. Bye.